So I lost approximately 0.63% on this stock. This is CAMPS. So I took a 6.25% position on this day, which is 12th of November. So let me explain this trade in detail. Why did I take this trade? How I executed it, and how I lost 0.63% on this trade. So I will remove the short term moving averages just to keep it simple for you. Okay, so this is the 50-day, the 150-day, and the 200-day simple moving average. I will draw the base for you. So from here till here, that's the base. And this is what I saw. Before taking the trade, this is what I saw. So as you know, before I consider a stock for purchase, I do comparative analysis, technical analysis, and fundamental analysis. Now, I will not take you to MarketSmith because that will take some time. The focus of this video is execution of the trade and what is the risk that you will face when you are trying to execute the trade. Okay. So fundamentally, this stock is strong because it has accelerating earnings and sales growth for the past 3 quarters. It has a return on equity of more than 17%, and the margin has expanded since the past 10 years. 10 years, it has almost doubled. So fundamentally, the stock is strong. Technically, the stock is strong. See, the price is above the blue, green, and the red. This is the basic criteria that we look for. The price should be above the 50-day moving average, which should in turn be above the 150-day moving average, which should in turn be above the 200-day simple moving average. So this is the basic criteria we look for. That's a strong stage 2 uptrending stock. Next, it has more than 10 candles in the base. So this is 0.1. So I start counting from this candle 1, 2, 3, 4, 5, 6, and so on. So it has minimum 10 candles in the base, which means minimum 2 weeks of consolidation. Then what about the consolidation? Let me draw the points for you. So this is 0.1, that's 0.2, that's 0.3, 0.4, 0.5, and 0.6. So if you notice, this point is higher than this point. This is higher than this point. So how do you draw these points? There is a separate video I have made on this. Please watch that video. Maybe I will put a link somewhere here. I still don't know how to do it, but I will try. And how to draw the color of this base. Again, for that, I made a separate video. I will maybe share a link or just type color or base in the search bar. You will find that video. Okay. So these are 6 points in the base. So point number 5 becomes my buy point, which is the high of this candle, which is 4785. So I draw a line there. 4785. Then what I do is I mark my buying range, which is 1% above the yellow line. So 4785, 5 multiplied by 1.01. So I have a calculator. This is 4832.85. So let's do that. 4832.85. So as you can see, I have drawn the 2 yellow lines. This is my buying range. The next day, when the stock tries to break out of this buying range on high volume, I want to buy that stock. Okay, that's my technical analysis on the stock. So you see tight price action here. So the stock looks strong fundamentally. The stock looks strong technically. Now what about comparatives? Now comparatives are a problem. The stock had a relative strength of less than 80, more than 70. So not great. The stock did have institutional demand, so that is good. The stock had a group rank of more than 40, which is not good. We want a group rank of within 40. And the group strength, the industry group strength was actually declining, not improving. So out of 4 factors, only one is in our favor, which is institutional demand. What are the 4 factors? Price strength, industry group rank improvement, and institutional demand, out of which only institutional demand is in our favor. Low price strength, poor group rank, and declining group rank, okay, or worsening group strength, and only institutional demand. So here is a stock which is technically strong, fundamentally strong, but comparatively weak. Don't forget to do comparative analysis, okay? Technically strong, fundamentally strong, comparatively weak. What does that tell us? What are the implications of this philosophy that we have built around the stock? The implication is that when we are trying to buy the stock, we have to be cautious because we are buying a stock that is comparatively weak. There are thousands of stocks in the market which are doing better than this stock. Okay. They may be technically or fundamentally weak, but they are doing better than this stock on a comparative basis. So the implication is that we have to micromanage this trade because we are buying into weakness. Okay. So micromanagement means I will have to go to the lower time frame charts to buy the stock. And if the price and volume don't give me confirmation, I have to start reducing my position size or exit the stock altogether. Okay. That is my plan, which I make the night before I'm planning to trade the stock. So this is called preparation. I cannot, what do you say? I cannot tell you the importance of preparation in words. Okay. Preparation is very important for us as professional traders. We should know what to expect from a stock. We should know which stocks to micromanage, which stocks not to micromanage. Moreover, there is general weakness in the market. In the past 4 to 5 weeks, we have seen an exodus of funds from India to China from the foreign portfolio investors. So a lot of money has gone out of India and moved to China, which has created pressure in the Indian stock market. Plus, the inflation data, recent inflation data has not been great. Plus, the corporate earnings have been weak. If when you combine all of this, when you see the index has been falling. Okay. So if the overall market is weak, it is going to put pressure on all the stocks. And when you read the newspaper, most analysts and traders, they say that this is a sell on rise market. Sell on rise means the moment there is some pickup in a stock, traders or investors immediately sell to book profit and the stock comes down, which is exactly what happened here. This is a sell on rise market. So when you when you look at all these data points, okay, uh, low relative strength of the stock, poor industry group rank, declining industry group rank or worsening industry strength, then FII is pulling money out of the market, inflation is high. When you connect all these dots, what that tells you is you have to be cautious in this kind of a market environment. There are market environments where it's exactly the opposite. Okay. FIIs are putting money, the relative strength is strong, inflation is under control, the central bank policies are good for the stock market, business is growing, triple digit earnings growth have been are being reported in the media. So it will be exactly opposite. The story is going to be exactly opposite. Okay. So when though in those kinds of market, do you think you need to micromanage a stock? No. Okay. So a very important concept I want to introduce in this video is flexibility. You have to be flexible as a trader. You cannot apply the same rule across all your stocks, across all market conditions. Okay. You have to keep changing your tactics. You don't have to change your strategy. You have to keep changing your tactics. For example, instead of 15-minute, I would use a 5-minute. Okay. Both are intraday charts. But since I want to micromanage the trade, I would go with a 5-minute. Now, some of you might say, Rohit, why would you go to 15-minute or 5-minute chart? It is too volatile. If you end up exiting a stock and then it skyrockets, then what will you do? Things like that. I have seen comments from subscribers like that. What is the need to micromanage the trade when you know that you've bought a technically fundamentally strong stock? What is the need to do so much of micromanagement? Why don't we just buy the stock, put an 8% stop loss and just forget about it? Well, that does not work because you have to protect the realized gains that you have made in the past. Imagine you buy 4 breakout stocks in a day, okay, out of which 3 begin to come down and hit your stop loss. That's a 24% loss. Okay, why would you take a 24% loss? If you start booking small losses like 0.63%, which I have booked on this trade, and when I bought Dixon, I made 15% on that. So one trade is allowing me to finance 15 more trades, or even more trades, more than even 15 if my losses are less than 1%. So I don't care if I sell the stock and the stock doubles from there. What I care about is, are my losses bigger than my profits? And if I develop this habit of cutting my losses soon without having the regret that after me selling the stock continues to go up. If I can do that, if I can control my losses, okay, even one profitable trade will allow me to finance multiple future trades. At least 10 future trades I can finance with my profit. That is why I really don't talk about reward, the concept of reward to risk. I talk in terms of gains and losses, because the realized gain allows me to take more risk. The realized gain allows me to take a bigger position size. And if there are realized losses, it decreases my ability to take risk. So, anyway, that was a short lesson on trade management. Let us focus on the trade. So, look what happened next day. So, this is called as a squat. If you read Mark Minervini's book, this is called as a squat. The price goes up and then squats back, closes below the yellow band. So, you end up buying in that range, and then by the time the day closes, you lose money. So, how did I manage the trade? So, let us go to the 5-minute chart. And by now, I think you understand why I am micromanaging the trade. So 12th of November, let us go to the 5-minute chart. So 5-minute chart, let's go to 12th of November. So see, 12th of November, 9:15. This is the first candle of the day. Okay. Remember, on a 25-minute, on a 15-minute time frame chart, there are 25 candles in a day in the Indian stock market. I think something similar will be there for the US market as well. Maybe 1 or 2 candles here and there. But in Indian market, there are 25 candles in a day on a 15-minute chart, which means there are 75 candles in a day on a 5-minute chart. So this is the first out of those 75 candles. The price tried to break out above the yellow line, but I did not buy, because see, on the 5-minute chart, this range looks bigger. On a daily time frame chart, look at this range. It looks very small, but on a 5-minute chart, it looks large. So when it broke out, I said I will give it some time. Let us give it 5 minutes. Okay, let me wait for 5 minutes and see where is the closing. So as you can see, it went up and closed below the yellow line. Not a good sign. Okay, so I did not buy the stock. Then next 5-minute candle was very encouraging. So I bought 1/3 of my position here. So my position size is 6.25%. 1/3 of that many shares I bought here. Why did I not put the entire 6.25% position size in the stock? Well, because after this it could come down. That's a risk. You need to have a perception of risk. If a stock can go up, it can also come down. So I'm waiting for more and more confirmation, which I got on the next candle. Although this is a large upper shadow, but still the closing is higher than the previous closing. Volume is high. So I added another 1/3. And on this candle, I added another 1/3. So I bought the stock in 1/3 installments within that buying range. So as long as I am buying at a price which is within this yellow band, because this yellow band is 1%. Okay, that's 1% distance. So as long as I'm buying in that particular range, I'm in a stock that is extended. Okay, so I buy the stock, fill the position, the stock starts to go up, breaks the second yellow line. Fantastic. Then it takes rest for a while during the day, and suddenly it breaks down, comes back into the buying range. Now, this is an alarm. When this candle closes, it is coming back inside the yellow band. That's an alarm. But I decided I will not sell the stock. I will allow it to close below the second yellow line, because the stock was showing technical and fundamental strength. This was something that I was expecting, because the stock was comparatively weak. This is something that I was not expecting. Okay, but I was prepared. I was not expecting, but I was prepared for it. So I sold all my shares at the close of this candle. So If you measure that, okay, that would be something like 0.30% return. But then it pulled back the next candle. Again, it pulled back. So again, I bought here all my shares which I had sold the entire 6.25% because it went down and it pulled back. When a stock pulls back into the buying range, we can give it another chance, because this often happens that comes down, shakes you out, and then it goes back up. So it went up, again it came back, again I sold here. So 0.3% lost here, another 0.33% lost here. So total loss on the entire position is 0.63 percentage. Okay. Which 10-15% on a stock, which gives it's a profitable trade for you. You can use that profit to finance 10 to 15 trades like this. See, can you understand the importance of booking a 10-15% profit? And size is the same. Okay. So you have to keep that thing in mind as well. So that is how I executed the trade. So as you can see, the day ended here. This white line and this white line, there are 75 candles in between. The moving averages don't matter on the lower time frame chart. So as you can see, my buying decisions are logical, not emotional. I am not buying based on thought or feeling or hunches. I am buying based on logic. I am buying based on a close. I am buying based on price confirmation. I am buying based on volume confirmation. I am selling based on price confirmation. I am selling based on volume confirmation. On this candle, see, the volume was low, but the price did not give me confirmation. The price could have easily dropped from here. So that is why I sold. Okay. Then it pulled back up. It gave me price confirmation. I bought the stock back again because I was expecting it to stage a pullback. That did not happen. So I quickly cut my position size. So that is how I controlled my risk. This is what I wanted to discuss. This is a lesson on trade execution risk. Okay. It is not easy to get into a stock that is breaking out. Just because you see a breakout doesn't mean that you are able to get into that stock. Even on this day, okay, it was not easy to get into the trade. Even on this day, I had done something like this and I got out. See what happened after this. I think I have recorded a video when I bought the stock here. It was a good decision to exit the stock because then it started falling even more. It was a good decision to exit the stock here because it started falling even more. So you see, micromanagement is helping me control my losses. It is helping me keep more of my realized gains of the past. Okay. It is very important as professional traders to cut our losses short and hold on to our realized gains, because when you have a 15% profit, like what I made in Dixon, when you have a 15% profit on a stock, and if it allows you to finance 10 or 15 more trades, even if two or three of those trades go in your favor, your gains will be more than your losses. So I want you to keep this point in mind. There is nothing wrong in micromanaging a trade. There is nothing wrong in going to the shorter time frame charts, as long as your objective is to limit your losses. Okay. So long video, I think, but I wanted to talk about this. And do not forget to download that swing trading checklist, positional trading checklist, stock categorization checklist that I have created for you. These are questions that you should ask yourself before you consider putting a stock on your watch list. So don't forget to download that. I have put all the links in the description box. Another thing I wanted to say is that I have relaunched my podcast to answer questions that are frequently asked by you, my YouTube subscriber. If you ask a question in the comment section, I will answer it on my podcast. Most of the times I'm answering it on YouTube, but I will answer it on my podcast as well, so that when you're driving or when you're traveling, you can just go through 5 or 10 episodes at a stretch, so that most of your questions get clarified quickly, so that when you actually come in front of the chart, you are not thinking about some basic things. Okay. Most of the things are already cleared up in your mind if you just listen to that podcast. The name of the podcast is the Rohit Radio Show. It is available on Apple Podcast. So I'm trying to create content there as well, because not every time it is comfortable watching a video. If you are in office, or if you are driving, or if you are traveling, you watch a video, it will drain your battery. It is best to listen to a podcast. So Audio and video content, both I am creating to add more and more value to you, because I know you have been supporting this YouTube channel. Uh, Thank you so much for that support, and thank you so much for your time. I hope this video has added value to your trading journey. Please share this video with your friends, family, and business associates. Have a fantastic day today. Thank you again.